And okay, great. Good afternoon, everyone, and welcome to the ACEC Research Institute's Future of Engineering Roundtable Series. And today's session, our 5th annual Industry Economic Update and Forecast. Before we get started, I just have a few housekeeping announcements. For the easiest view, move your mouse to the top of your screen and select Gallery View. This will allow you to see all panelists. Your microphone was muted upon entry, but if you wish to ask a question or offer a comment, please feel free to type it into the Q&A box at the bottom of your screen. We will do our best to answer as many questions as time permits. The event is open to the media and the press is invited to participate, as with our other attendees, by asking a question through the Q&A box. We are recording today's event for future viewing. If you require any technical assistance, please feel free to send a message to ACEC Research Institute privately through the chat box, and I will be happy to assist you. Now, allow me to introduce the Executive Director of the ACEC Research Institute, Daphne Bryant, who would like to say a few words.
Thank you, Carrie. Good afternoon or good morning, depending on where you are. Welcome to our 5th annual look at the economic assessment and the always anticipated 5-year forecast. And so we have with us today John Gray from Rockport Analytics, who is our resident economist and author of this study, and also Joe Bates, who is a senior research consultant at the ACEC Research Institute and is going to kind of moderate us through this and share some information from his perspective as well. So we're excited to have both these gentlemen with us. And I know, John, you've got a ton of slides to share with us. So I am going to turn it right over to Joe so that we can get started and jump in.
All right, great. Thanks, Daphne, and welcome everybody. As Carrie alluded to, please feel free to put your questions in the Q&A as we go through. I will be monitoring that question box and pose the questions to John as we receive them. And there's 3 sections to what John is going to present today. One is a little bit of a look backwards to see how the industry has performed recently, as well as the second piece, looking at how our industry looks today, how important it is, how many jobs we have, how many taxes our industry pays, et cetera. And then the third piece will be that forward-looking, what is the forecast? What are the elements of the economy that could impact the performance of our industry? So we'll get into a lot of discussion about what John is anticipating over the next year or so in terms of effects that could impact the forecast. So, John, with that, I'm going to let you kick it off here, take a look at the review of 2023, and tell us, how did we do?
Wonderful. Well, thanks, Joe, and welcome, everyone. Very excited to be with you here to unveil the results of this year's economic assessment and outlook. So, as Joe alluded to, we're going to start today by looking backwards a little bit and understanding how the industry has performed as of late. So what you're looking at here is annual industry revenue going all the way back to 2008. I'll talk a lot today about top line revenue. You'll also hear me talk about economic output. Those 2 things are technically a little bit different, but very similar and almost interchangeable. So those are a lot of the measures from a top level view that we're going to be looking at today. We've got a deeper history of revenue performance here, but I really want to draw your attention out to the right-hand side of the chart here. If we look at 2020, you can see the declines that the industry witnessed, 6.6% during the COVID pandemic. And then you can see how the industry has performed since then. So 21 and 22, we had record-breaking years. So double-digit growth essentially over both of those years. A lot of stimulus being introduced, both monetary and fiscal stimulus into the U.S. economy. Things were obviously snapping back from COVID. We had IIJA. So really hitting on all cylinders over that period. If you look at 2023, this is obviously the last full calendar year that we have data for. We do have some additional data for 2024, and I'll speak to some of those data points as we move through the webinar here. But the last full year, 2023, we saw about 5.5% growth. $436 billion in revenue was generated industry-wide. I will say that these numbers are not completely final. We're dealing with a lot of government data that tends to have some pretty big lags and some revisions. And so the data that we've been looking at most recently, even since we published this in early October, leads me to believe that that number might be revised upward slightly by the time we finalize these. So I'm guessing we're going to end up more in about the 6.5% range for full year 2023. But what you can see here quite clearly is that we're doing very well still, but growth is beginning to moderate here in 2023.
And John, a quick question for you. That 5.5%, again, you said it may come up a bit, but how does that compare to what you were projecting a year ago?
Yeah, it's slightly lower, Joe, and we'll get into that a little bit more when we start to talk about the forecast and how things have been trending. We were projecting about 7% growth, I believe, when we did the work last year. So like I said, I think we're going to revise upward. We're going to be closer to that 7%, but we're probably not going to get quite there once we have a final tally for the year.
Okay, great. Thanks, John.
Okay, so next, we want to take a look here at some relative performance. So starting with this chart on the left, what we're looking at is engineering and design services, growth in the industry relative to growth among all industries in the US. And so the orange line is engineering and design services revenue growth. The gray line represents the growth across all industries. And what you can see here is that coming out of the pandemic, both architectural engineering and related services, as well as industries around the US, saw that big surge in 21 and into 22. But engineering and design services actually lagged the broader economy slightly over that period. But since about the middle of 2022, there's been this outperformance. So you can see quite clearly there that through 22 and most of 23, save for the one quarter that we had that drop where the industry fell below growth of the broader economy, we have been outperforming. And this comes despite the rise that we've seen in interest rates over the last couple of years. If we look at the chart on the right, we're comparing engineering services with architectural and related services. So these are really the two big industry components when we're talking about engineering and design services. So when we look at the breakout of revenue over time, engineering services comprises about 3/4 of revenue generated in the broader engineering and design services industry, and architecture and related services makes up the other 25% of revenues. So what we're looking here again is at that relative growth. So how have architectural services performed against engineering services over the last year or so? And what you can see in 2023, they're moving together in terms of how the growth rates are rising or lowering over time since the pandemic. But you can see that there's been that outperformance of engineering services. In fact, architectural services has slowed to just under 1% annual growth when we look at it over the last couple of quarters. And I think there's a couple of reasons for this. One, architectural services tends to be tied a little more tightly to the broader economy. So when GDP, when the economy is growing at a faster rate, we tend to see architectural services perform better. Likewise, when we see the economy start to slow a little bit, that's when we see an even bigger slowdown in architectural services. And then the other thing that we see is that architectural services tends to be much more tied to the commercial end markets of engineering and design services, those that have not performed as well over the last year or so. And so we'll talk about in a few minutes sort of end market performance to give you a little bit of insight as to where we see these two parts of the market heading over the next couple of years.
So, John, 5.5% top line growth, maybe revising upward. I know you have a lot of other KPIs or pieces of data that you'd like to share with us to compare. How did things grow relative to that top line number in some of these other metrics? So, can you share with us some of that data?
Sure, Joe. So, yeah, as we tend to see a lot of these other KPIs that we track on a regular basis follow along with revenue, as you might expect, right? So revenues, as we talked about, up an estimated 5.5% to $436 billion last year. We saw jobs, so the total full and part-time jobs that are supported directly by the industry, we're up about 3.4% over that same period. I think this number would have been even higher if it wasn't for some of the supply constraints and labor challenges that we see in the industry. We're going to get into some of those details here in a few minutes. Total establishments, this is essentially the number of engineering and design services offices around the U.S. We're up 5.1% last year. Now, this comes from existing firms that are expanding and opening new offices around the country. And it also comes from new business formations. So new companies, new startups over the last year that have added offices around the US. In terms of the average wage, that average wage was up last year 4.3% to $109,000. The direct economic contribution of the industry, I'm going to talk a little bit more about economic impact and the economic significance of the industry in a minute here, was up 4.7% last year. And then the fiscal impact, the total federal, state, and local tax collections that were generated due to industry activity were up 6% in 2023. So really just a strong year overall, Joe. So not just for revenue, but across all of these KPIs that we're tracking.
Yeah, one thing I think, John, that we've heard a little bit of feedback about is the wages number, that a lot of firms are seeing this number much higher than that 4.3%. And when we conducted our survey, our sentiment survey in Q1 earlier this year, that number for firms who responded, member firms who responded to the survey, was about 9%. So there does seem to be a little disconnect between some of those BLS numbers regarding wages and what some of our firms are seeing. So I know this is a overall average, but there are, I think, my point is certainly there are firms that are seeing much more pressure on the wages than this number would even indicate.
Yeah, absolutely. It's a great point, Joe. And a couple things to that. One is these, like we're expecting to see revisions in revenue, we have seen upward revisions in wage growth. And so I would not be surprised in the slightest if we saw some of those upward revisions. The other thing to keep in mind with these numbers is they're inclusive of all of the employees across engineering and design services. So we're not just talking about engineers specifically. Engineering salaries we've seen have gone up more than this rate. This includes admin. It includes all of the professionals that are employed at these firms. So that's another thing to keep in mind with that 4.3% growth rate.
Yeah, good points to make. Thanks, John. So you were talking about wanting to share some more stats about the significance of our industry. So let's go ahead and turn our attention to that, John.
Yeah, so this is something that we do every year. We go out after we've assessed the industry in terms of revenue generation. We want to understand what the broader impact of the activities of all of your firms within the engineering and design services industry mean for the broader economy, right? And so These numbers can be used for advocacy efforts. It's really important for us to be able to communicate, the importance of our industry, not just to other firms in the industry, not just to other stakeholders in the industry, but more broadly speaking, what does engineering and design services really mean for the broader U.S. economy? And so to do that, we capture that revenue, that $436 billion. We use an economic impact model. It's a model that basically has the structure of the U.S. economy, understands the supply chain and all of the interrelationships of the U.S. economy to be able to model what that activity means for the broader U.S. economy. And so $436 billion last year translated into about $656 billion in total GDP. And so for every dollar that's generated in engineering and design services revenue, we see about $1.50 that's generated in US GDP. That number was up about 4.7% over 2022 levels. You can also see here how that breaks out in that third column here, that value to US businesses. There was a direct industry impact of $251 billion last year, and a combined impact between indirect and induced impacts of $405 billion. So I know this is a lot of econ speak here, Joe. In a minute, I'm going to talk a little bit more about what indirect and induced impacts really mean. But suffice it to say, there is a multiplier effect of that revenue that is generated on the broader economy. That multiplier effect also impacts jobs, right? I talked about, I think, 1.6 million jobs directly supported or employed by the engineering and design services industry. When we look at the broader impact, there's actually 5.6 million jobs that are supported by the activities of the industry. And then lastly, I talked about the fiscal impact. You can see here how that breaks out among federal tax contributions, $91.8 billion generated last year. And so this is generated through payroll taxes, income taxes, state and local tax contribution, $43.5 billion generated last year. And this is collected over a number of different sources. Think about property taxes, you have income taxes that are generated, you have business taxes. And so again, I think this is data that can really be used strategically. We have a lot more detail in the report about how this breaks out and what the sources of these tax revenues are to really be able to understand what the industry means for the various different jurisdictions that your firms are working in.
I also just wanted to add, in the full report, obviously there's a lot more data than we're going to get to today, but in the back, in the appendix, we have all of this data broken out by state. And I know, John, you're going to share a little bit of that, but whether it's the revenue or the jobs, the taxes, et cetera, all broken out by state. So this is a great resource for the ACEC state member organizations to use when they're talking to their local and state legislators and regulators and so forth. So just wanted to point that out as well.
Yep, great point. Thanks, Steph.
So, John, you were mentioning you want to talk a little bit about direct versus indirect and what all that means. So talk us through what all these numbers here on this slide are pointing at.
Sure. Well, I'm not going to thankfully talk through all of these numbers, Joe, because there is a lot here. And, the point is not exactly what the level of these numbers are, but I think to illustrate, the number of industries that are impacted by engineering and design services. And so the table that we have on the left has all of the major sectors of the U.S. economy. And you can see that what is broken out here is the number of jobs that are supported across those sectors in the direct, indirect, and induced impacts by the engineering and design services industry. And so the direct impacts, you can see quite clearly, all come from one super sector, that professional, scientific, and tech services, that is where the engineering and design service industry lives. And so all of those jobs that are directly supported or employed by the engineering and design services industry are there in that direct column. The indirect column includes all of the jobs that are supported along the supply chain of the engineering and design services industry. So at all of your firms, you're obviously generating a lot of revenue, and you have lots of partners and contractors that you work with in supply chains, in technology and accounting services, in insurance, that are all impacted, and part of that revenue is going to feed those industries and support employment, wages, and economic impact in those industries. And so all of the jobs that are supported along the supply chain in these industries are there in that indirect column. And then lastly is the induced column. And this is really when we talk about a multiplier effect of revenue generation. And so when that revenue is generated within engineering and design services firms, a lot of that revenue finds its way to employees, right? And then those employees that are paid a salary, they go out and they re-spend those wages on various different goods and services within the US economy. And so the model that we use helps us to understand how those wages are re-spent and what industries get impacted by those wages. And so that's what's represented in the induced column. So you can see on the right-hand side just some examples of the total job counts of these various different sectors that the industry employs. So 2.1 million workers in professional services, almost 500,000 workers in health and social services, 227,000 in real estate, 76,000 in information and communication services, 50,000 in ag, forestry, and fishing. And so just really a broad array of industries that our sector touches here.
I think this slide, John, shows really, really well. I mean, there's a lot of numbers, but it shows really well how the industry filters out through the rest of the economy. And so I think it's always impressive to see that. Daphne was talking a little bit about some of the state level data, and I know you have a little of that to share with us here as well.
Yeah, so as Daphne alluded to, we go in, we do the national impact study, and then we're drilling down further at the state level. I'm going to share a little bit of that data with you today. As Daphne mentioned, there's really a lot more in the full report to really drill down to. But I wanted to look at revenues here at a state level. The table that we have on the left-hand side looks at the top 20 states ranked by revenue growth in 2023. And so you can see the top of the list: Wyoming, Idaho, Delaware, Utah, Kansas. Some smaller states, you know, we do tend to see a little bit more volatility in some of these states. So not surprising that sometimes we'll see some higher growth rates. But we had about 9 or 10 states last year with double-digit growth rates. And you can see on the right-hand side, when we look over the last 5 years at who's generated the most revenue, those tend to be the largest states that have the most activity. So Texas generated $11 billion over the last 5 years in additional engineering and design service revenue. California grew its revenue or expanded by $9 billion. Almost $7.5 billion expansion in Florida, $4 billion in Colorado, and almost $3.5 billion in North Carolina.
So, John, why are we seeing higher growth rates in the smaller, relatively smaller states? Is there a particular reason for that? Or, you know, you mentioned volatility, but is there something behind that?
Well, I think it's a mix of things, Joe. I think volatility has a lot to do with it, right? And so these states, the bigger states, tend to have more stable growth rates, right? And so if you have a few big projects in a small state, that's going to show up a lot quicker in the growth numbers than if you have some big projects in a state like Texas or California. And so there is a little bit more volatility there. Also, in some of these states, we are seeing a pickup of growth in different areas. If we go to the next slide, we can see kind of regional performance. And this takes revenue a step further and models out that revenue in terms of job growth and wage growth. And here we're aggregating regions. These are actually census divisions. So there's 9 census divisions that we're looking across here. And what you can see in the title of the slide, and by looking at the data represented in these divisions, is that states in the South Atlantic and the mountain regions or divisions led growth in 2023. And so there are some states, like we saw on the previous slide, like Montana, Wyoming, some mountain states, Utah, that are seeing growth and that there is some secular trends that are driving growth in those areas. So it goes beyond just the volatility, but that's part of it. You know, the South Atlantic, likewise, we continue to see growth. We've seen growth in the South Atlantic. I don't think it will be a surprise to anyone that growth, you know, revenue growth in engineering and design services tends to follow population, right? When we have population move, we tend to see the built environment follow, whether that's the building of residential properties or commercial properties, you know, office space, entertainment, what have you. That's where it goes. And we've seen a lot more flexibility, Joe, in the workforce over the last couple of years, and a lot more migration. So a lot of the trends that we saw prior to the pandemic have been accelerated. We continue to see population growth in the South Atlantic states, in the mountain states. You know, people tend to go where there's more affordability, right? And there's better climate, better weather, a higher standard of living. And so we continue to see those trends. It's not going to go on forever, right? Because as demand picks up and these places start to get more and more populated, you know, they sort of lose their advantages from a cost perspective and maybe even from a quality of life perspective. And so this doesn't mean that we're going to continue to see this on and on and on, but I think for the next couple of years, we can expect to see some of the same, a continuation of those trends we've seen over the last couple of years.
So John, we have a question from the audience asking you to please define the revenue by state. Is this revenue growth for engineering firms, or is this revenue growth produced by organizations, both public and private, from those states?
Yeah, so it's the former, Joe. So this is the revenue that's actually generated within these states, or in this case, the census divisions that those firms are located and they're doing activity, and those projects are located in those divisions.
Okay, great. Thanks, John. All right, so we've gone through quite a bit of data already here. You know, how we performed in 2023 compared to the prior year, what the industry looks like in terms of its size and the strength of it. So now for the big question, John, this is what everybody looks forward to every year. What is the forecast for this year and what might impact it? So drum roll. I need to get some sound effects here, but here's the drum roll and boom. All right, John. So share with us what's going on in your future forecast.
Okay, good. Thanks, Joe. Yeah, we're gonna tiptoe out onto the edge of our limb here, and we're gonna talk about where we see things heading over the next few years. So again, here we're looking at essentially revenues, economic output within the industry. The gray bars in this chart represent the historical data. So you can see in 2023, the numbers that I've been talking about, that $436 billion that was generated last year. And you can see how we expect that to grow over the next few years. The growth rates are in those orange boxes. So 2024, this year, we're expecting that growth is going to continue to moderate a little bit. 4.4% growth is what we're expecting this year. This is obviously still a forecast. We don't have full year's data yet at this point, but we do have a fair amount of data from the first half of the year and even from the third quarter that we can rely upon. So we feel like this is a pretty strong estimate. I'm going to give another caveat that since we released this, since we did this analysis about a month and a half ago, we have seen additional data that, like in 2023, where we expect that number to be revised upward, I expect 2024 to be revised upward a little bit too, Joe. So I think, I wouldn't be surprised if we're north of 5% by the time we finally see the end of 2024. We have seen a little bit more strength over some of the data that we've seen come into the third quarter than what we were anticipating.
Yeah, I was going to ask about that, John, because some of the other data that we get from Thomas Grogan, who's a ACEC economist as well, the monthly data that he provides us and quarterly data, year over year, it's much stronger than that 4%. So I was also thinking, maybe we're going to see some upward revisions there.
Yeah, I think that's definitely the case. So I think we can consider 23 and 24 very conservative at this point. I think both are going to be upwardly revised when we get final tallies of data. And we'll talk a little bit about the other things that we see supporting the forecast, but we are seeing some positive momentum just in general in terms of the forward-looking view here. But we do expect a continued moderation. So I think while the growth rates might change, I think the shape of the forecast is going to be unchanged. In other words, we expect that 2025 is going to be a little bit weaker than this year. And so our projection is for about 3% growth. And then we expect things to pick up again through the forecast horizon. So you can see by 2029, we're expecting to be back at about 3.8% growth. This is significantly faster than the average, the long run average. I think the long run average in the industry is about 3.4%, 3.3, 3.4%. So by the time we get out to 2029, we're definitely going to be, above average in terms of our expectations for the industry, Joe.
But nonetheless, as you said, John, the big word is moderating and sort of getting back to trend. What is the difference, John, between nominal output growth and real output growth? What's causing that delta there?
Yeah, good question, Joe. So nominal output includes inflation, right? And so as we know, there's been a lot of inflation over the last couple of years. It started to come in over the last year or so, but still higher than what we see on average, right? And so in order to be able to better understand the true impact or the true growth, we strip inflation out of those numbers to look at the growth rate in real terms. And so nominal output is just that spending that includes inflation, so the numbers that are in the chart above, and real output is numbers that strip that impact of inflation out. And so, one thing to pay attention to here is the fact that we expect inflation to continue to normalize over the forecast horizon. And so the gap between nominal and real output should be closing. And so if you look, for example, at 2024, this year, we're expecting about 4.4% in nominal growth. And that translates, once we account for inflation, to about 1.3% in real growth, Joe. But if we look all the way out to 2029, when we expect there to be more normalized levels of inflation, that 3.8% nominal inflation translates to a higher percentage in real output growth. And so we're getting more bang for our buck in terms of real growth as inflation subsides over the forecast horizon.
All right, so I know you're going to talk about a lot of different pieces elements and factors that could affect this forecast, John. Why don't we get into that? I'm sure we're going to come back to the inflation piece in a few minutes as well.
Yeah, so I want to start just by looking at some of the macroeconomic drivers, really the headline measures. These are the things, Joe, that we track on a regular basis to really understand what's happening in terms of the macroeconomic environment, which obviously has a lot of influence over the direction that we think the industry is headed. So starting just by looking at two fundamental statistics, employment, U.S. employment and U.S. GDP growth. Starting on the left, we're tracking the monthly change in total U.S. employment. You'll notice a couple of things about this slide. So this starts in 2021, and so this is obviously coming out of the pandemic period. So it's important to have that context that we're coming off a really low base here. So we lost a lot of employment temporarily in 2020, and so in 2021 and 2022, you can see that we're really rebuilding that base in terms of that employment growth. So all of those monthly gains were really just trying to recover, what we lost during the pandemic. But by the time we got to early 2022, we had recovered all of those jobs, right? And so everything from 2022 onward in this chart, Joe, is really new net gains in terms of employment. And so we've had a lot of really, we've had a really strong labor market over the period. We've been at or just below 4% unemployment levels over that period. And so very strong employment. Obviously, that also translates into strong GDP growth. And so you can see a somewhat similar trend in the GDP chart. We had a surge coming out of the pandemic, again, coming from a lower base, 5.8% growth in 2021. We did see that growth start to slow in 2022, about 1.9%. This is when inflation was really ticking upward. But we've seen a ton of resilience over the last couple of years. We've been talking, and many economists have been talking about this potential for a recession for 2 years now, the most widely anticipated recession in history, right? And it's one that just hasn't come. And so despite the fact that we've seen rising inflation that we'll talk about here in a second, rising interest rates, the U.S. economy's been really resilient. And so that's the backdrop that we have right now to operate from in terms of our outlook for engineering and design services.
John, I think I love how you have the history of these charts. It really helps to show the trends here. And, the point in 2023, 2.9%. This year, you're expecting 2.8%. I mean, this is not flashing recession at all. So one other question I have for you is that Q4 of this year, where we are right now, do you think it's possible we might actually see stronger growth in Q4 because maybe people are anticipating policy changes that, let's say the federal tax credits for electric vehicles go away next year and people start hearing about that and rush out and go buy cars all of a sudden. Do you think that could affect Q4, or is there just too much uncertainty to know right now?
It certainly could, Joe, and we'll talk in a few minutes about some of the policy changes that we're expecting and a little bit about the impact of some of those changes. I think, you can see here clearly that Q4 was expected to be somewhat weaker. I think a lot of that weakness comes just frankly from the uncertainty around the elections. A lot of times we see, firms tend to sit on their hands during periods of uncertainty. And so a lot of times we just need direction one way or another. And so I think a lot of it is just having the elections behind us. Certainly there's going to be impacts of policy changes. But yes, certainly we could see some shifts. We might see that growth come in a little bit different than what we're expecting in Q4, but I don't think it's going to be drastically different than the projection that we have here.
All right. Thanks, John.
So yeah, let's take a look at inflation. I mentioned it a couple of times already. It's something that we've been tracking very closely for the last couple of years as we've seen these huge spikes in inflation, coming out of the pandemic as we had all of this stimulus injected into the economy. And you can see that in the chart on the right with the average federal funds rate, this is the rate that's set by the Federal Reserve Bank. They've been trying to tame that inflation rate over that period of time from 21 through 23 by drastically raising interest rates, right? And so I think it's important to put our forecast into context by looking at what has happened with inflation and the progress that we've made. So on the left-hand side, you can see core services CPI and core goods CPI. And what you notice right away in that gray line, the core goods CPI, is that rate is all the way down below zero. So we're effectively seeing no price increases in goods right now. When we look at the services side of the economy, Joe, things are a little bit more sticky. And so inflation is coming down, but it's coming down at a much slower rate. And so you can see that quite clearly. It's going to take us a little bit longer to get services inflation back in line. There's a lot of things to manage there. We've got wages that have gone up that are not coming back down. Once you give somebody a raise, it's hard to take that away, right? And so those are baked into those services numbers. And so that's going to be a lot stickier than goods inflation was. But nevertheless, we've made enough progress that the Federal Reserve feels comfortable that they are, if not at their target rate of inflation, they're close enough to that target rate of inflation that they can start cutting interest rates. And so we've seen that now for the last couple of months. Earlier this month, we saw a 25 basis point cut that followed a 50 basis point cut in September. Right now, the futures markets there's another Federal Reserve Bank meeting in December, and the futures markets have about a 60% chance of us seeing another 25 basis point cut in December. We're seeing some conflicting data in terms of inflation and growth and employment. And the Fed is going to be very data dependent moving forward. But I think the important thing to note is just where we are in this curve. Inflation rates clearly coming down, interest rates clearly coming down. They might not come down as fast as many would like, but it just gives us a little bit more confidence into the stability that we're seeing in terms of economic growth and the backdrop that we have moving forward for the industry.
All right, so I'm hearing a lot of confidence, John, which is always great. But what are some of these potential policy changes with the new administration, and how might they affect your forecast?
Yeah, so we're still obviously digesting a lot of this, Joe. So the forecast was conducted before the elections. Some of this, obviously, we didn't know which way the elections were going to break. And so some of this is kind of baked into the forecast. Some of it isn't. But there's a couple of, key areas that we're tracking in terms of things that might impact the macroeconomic environment and might impact engineering and design services opportunities over the next couple of years. And so there's really three major areas: trade policy, fiscal and tax policy, and immigration policy that we think could have some material impact on the macroeconomic environment over the next couple of years. The first one I'll talk about is trade policy. I think, we all know that the Trump administration is very adamant on tariffs. The proposal is for a 60% tariff on Chinese goods, 20% on goods of other global trading partners. We don't think that we're going to see anything nearly that aggressive at the end of the day, but certainly there's going to be an objective to get some form of tariffs on China and some on global trading partners as well. And that's likely to mean higher inflation, right? If we're adding a tariff to a lot of the prices of goods that are being imported from overseas, U.S. consumers are going to pay more for those goods, right? That higher inflation, as we just talked about, is something that we've been trying to fight. The Federal Reserve has been fighting by raising interest rates, now finally normalizing interest rates. And so what this could mean is that we do end up seeing interest rates stay higher for a little bit longer. And what that means is we're going to see some tighter financial conditions. We're going to see less investment potentially. And we could see more moderate growth. Also, those higher rates are going to mean higher federal deficits, right? So if we see higher interest rates, We know that we've got a lot of debt in this country right now. We're expecting to see a lot more over the next couple of years. And the rate that we're going to be paying on that debt is going up. And so something to look at and think about in terms of the prospects for growth. I think we also have to think about the possibility of retaliation and the impact that would have on exports. I think the good news for engineering and design services is it's so domestically focused. It's a very low percentage of the industry that's being exported, and so that has kind of a smaller impact. But I think obviously trade policy is something we're looking very closely at. Fiscal and tax policy, I think, has the potential to be a boon and to actually support more economic growth over the next couple of years. I think it's pretty much a foregone conclusion that the 2017 tax cuts will be extended. I think there's a potential for additional income tax cuts, whether that's eliminating taxes on tips or Social Security or getting rid of the state and local tax deduction cap. Also, lowering a corporate tax rate to 15% could also be stimulative for the economy and stimulative for the industry. And then lastly, looking at immigration policy, there is certainly the intention to deport millions of undocumented workers. I think broadly speaking, that probably wouldn't be an enormous strain on our labor markets. But when we look at something like the construction industry, there's a very high proportion of workers, undocumented workers, estimated in the construction industry. And so that would put a big strain on the labor challenges and the shortages that we already have. Again, sort of exacerbating the inflation challenges. So I think bottom line, Joe, is there's a lot of unknowns, right? In terms of, we know what the policy objectives are, but what is actually going to be doable and what is actually going to happen, we don't really know. All we can do is sort of track kind of what's going to happen. Who's the Treasury Secretary going to be? Are we going to have, somebody that's going to give a little bit more guidance as to maybe a more constructive trade policy? How are these things going to shape out over the next, months and year or so? Looking at those and sort of reading the tea leaves as those things happen, we'll incorporate those into our forecast as we go through and work through revisions here. But bottom line, there's some net gains, some net positives and net negatives that could come out of policy over the next couple of years.
All right. Well, that's very helpful, I think, John. So thanks for walking us through these, and we'll certainly be looking to you early next year to help us, digest the actions that take place or don't take place. I know you also have some other information for us. So how is the IIJA holding up? And I think a question along with that, maybe as a follow-up for you, John, is anything going to happen to IIJA funding with all Republican control of the House and the Senate and Trump being in office?
Yeah, it's a good question, Joe. I think to start with your question, I don't think anything's going to happen. There are certainly, the Trump administration, Donald Trump has talked about maybe repealing some of IIJA. I don't think that's feasible at all. I think there was bipartisan support for the bill, giving the slight majority that Republicans are going to have in Congress. I don't think it's likely. There's been really broad-based support. A lot of the funding's been put in place, about half of it. So of the $1.2 trillion, we can see about $568 billion has been committed as of this month. And obviously, the current administration is working quickly to roll out dollars. And so the good news is we are seeing acceleration, right, of the awards, and maybe it'll help kickstart, getting more of those dollars into the economy and into the engineering and design services industry over the next year or so. But I think they're pretty well protected. I think we still have a number of years yet that IIJA is going to continue to really support revenues. We think, somewhere in line of around $10 billion per year added to the industry based on IIJA for the next 4 or 5 years, because it is going to take some time for all of those dollars to roll out. So things are moving, and we do think that those are going to be the end markets that, and I'll talk about this more in a second, but those are going to be the end markets that really flourish over the next couple of years, those that are tied to IIJA projects.
So John, we have about 10 minutes left here. So I know you got some state data here and a few other things, particularly talk about the end markets and labor. So why don't you walk us through these here as well?
Yeah, just quickly, Joe, we pulled this together just to look at kind of the per capita spending, just to give everyone a sense of how those dollars are being distributed. I think it was interesting to see that there is, a pretty fair distribution across states. We don't see a lot of states, when we look on a per capita basis, really out of line. And then when we look at even blue states versus red states, we don't see any real favoritism in terms of where those dollars are ending up. And so, we will continue to monitor this, obviously, over the coming quarters and years here as IIJA rolls out. But just interesting to see, and I thought it'd be interesting for members that are operating in these different states to see exactly where those dollars are going here.
All right, so let's talk about sectors, John. I love this slide. It's one of my favorites.
Well, yes. So looking at these sectors or end markets for engineering and design services, what we're looking at here is essentially a mapping of those sectors. The size of the bubble for each of those sectors represents the size of that market in terms of construction put in place in 2023. Where that market sits on this mapping from left to right along that horizontal axis represents how that market performed last year in 2023. So how that market grew. If you look at where that market sits from top to bottom along the vertical axis, that tells us how we expect that market to perform over the next 5 years. So if you look, for example, at the far left-hand side, you can see that single family residential housing, the only end market to post negative growth last year. And so we saw negative growth, obviously a very interest rate sensitive part of the industry. The good news is for single family housing, they're above that line moving forward and actually sit pretty high. Given the pent up demand, we think that the growth in single family residential is going to be above average over the next few years. Conversely, if you look at multifamily, we think that the growth in multifamily is going to lag over the next 5 years. A lot of things feeding into this, but really a pretty big glut of multifamily housing and oversupply. And so we think that those dynamics will shift over the next few years. When we look at the parts of the market that we think are going to outperform those higher up on the mapping here, you'll see a lot of those that I mentioned, Joe, that are tied to IIJA, right? You can see transportation, streets and highways, sewage, water, waste disposal, power, conservation and development. And so those are going to be the markets that really we think are going to outperform. You can also see manufacturing. Manufacturing just boomed last year. And a lot of this is about the onshoring efforts that we've seen. We think that market's going to slow, although as we're talking about under the current, with the Trump administration incoming, I think we might actually see manufacturing do a little bit better. There's going to be a focus, obviously, on domestic manufacturing. Tariffs are going to support domestic manufacturing. And so we might see that market actually continue to outperform. And then those markets that are going to underperform are those cyclical markets that I've talked about being really tied directly to the economy, commercial construction, amusement, recreation, office and lodging. We think those are going to underperform over the next 5 years here.
So I just want to mention that we see this very much reflected in our quarterly sentiment survey as well. And, it's really remarkable to me to see how closely they align. So feel free to check out the Q4 sentiment study as well. We also have a lot of information there about jobs and hiring. And John, you were alluding to this earlier. It still looks like we're in a bit of a constrained labor environment. Is that correct?
Yeah, Joe. So, want to end and kind of wrap up with a couple of slides that just give everybody a sense of what the labor market looks like. This is something that I know that from my conversations with a lot of you about your firms and your challenges and just analyzing the data and understand what's happening in the market. I know this is a huge issue and one that we've been tracking for a couple of years. When we look at this chart on the left is something that comes from the BLS. We've been tracking this for 3 or 4 years now, looking at professional and business services hires versus job openings. And so the orange line represents job openings, the blue line is hires. And so you can see prior to the pandemic that these two lines pretty much moved alongside of one another, right? And that's what we see in a healthier labor market, right? When a job opens, we see a hire, shortly thereafter. And so all of the workers that firms want to hire, they're able to. That has not been the case for the last couple of years. And so you can see that gap really widened following the pandemic. We got all the way up to about 2 job openings for every hire in 2022. We have seen that gap close. And we were anticipating this to maybe get back to normalization when we started to see that gap close in early 2023. But what you can see here, Joe, is clearly that gap has remained, stubbornly wide. And so we continue to sit at about 1.5 job openings for every hire that we see. And so that just tells us, what kind of challenges that we have from the supply side. That obviously impacts wages, puts upward pressure on wages. You can see on the right-hand side, the orange line represents the growth in engineering and design services wages. We talked about this before. We think this is probably conservative at 4.3%. That number is probably even higher. But it's important to see that how that line is moving relative to the all industry average, right? After the pandemic, we've started to see normalization in wage growth amongst other industries. We're seeing the opposite trend as we look at industry wages. And unfortunately, I don't think it's going to get a whole lot better, Joe. When we look at the supply factors, when we look at demographics, right? What we've got here is the proportion of workers across sectors age 55 plus. And so if you look at in 2023, so the last year at the far right-hand side that we had data, you can see that if you look at all industries, those workers age 55 plus represented about 23% of all workers. When you look at engineering and design services, that orange bar, it's about 27%, right? And so these are workers that are nearing retirement. They're likely to leave the labor force over the next couple of years. It equates to about 450,000 workers, Joe, that we think will be leaving the labor force over the next 5 to 10 years. So it's a real challenge for the industry. It's a real challenge for firms on the supply side, really getting younger workers involved in engineering, figuring out how to retool current labor forces, a lot of challenges, and then looking to technology as well to help fill in the gap with some of those labor challenges on the supply side.
So, John, I know you've got a couple more slides here. We're running out of time. I'm just going to mention them quickly here. We have a slide on productivity and how productivity in our sector has lagged a little bit compared to other sectors. So that's not necessarily a good thing. But AI, we're looking to AI to possibly help improve productivity. But obviously, we're still at a very low penetration rate for that. And it's going to grow, I'm sure. There's a lot happening in that space. We'll talk more about that on another webinar. But if you could briefly here, just sort of give us your key takeaways and we'll start to wrap this up today.
Yeah, so just to kind of walk through some of the key points here, the industry, a very good year in 2023. Again, growth moderating to 5.5%, but we think that's going to be a little bit higher, probably about 6.5% growth, $436 billion in revenue generated last year. The economic contribution of that, very important, the engineering and design services industry to the broader US economy. So about $1.50 is added to GDP for every dollar in revenue generated. I talked about the broad impact that the industry has. So all of the other sectors that our industry touches, when we look at the supply chain impacts and we look at the income impacts of the industry, those income impacts are outsized too relative to other industries, because the average wage paid across the engineering and design service industry is about 60% higher than the average wage for all US workers. So very important in terms of the multiplier effects that the industry has. When we look forward, we expect that growth is going to continue to moderate over the next couple of years before picking back up again. The really good news, I think, is that we see a very strong macroeconomic backdrop, in terms of this soft landing. When I say strong, I don't mean that growth is accelerating. We do see growth slowing and normalizing, but we see a lot of the other measures that tell us that we're not likely to encounter a recession. We're likely to see slower growth before we can sort of pick up the pace again. Obviously, there's a lot of factors that we're watching with the incoming administration and what these policies are going to mean for the macro environment over the next couple of years. IIJA is going to continue to be a boon to the industry. Those end markets are really going to benefit that I talked about from IIJA. We do not think that IIJA dollars are at risk with the incoming administration. So I think that should continue to be an area of focus for firms moving forward. And then labor. So, again, that's going to continue to be a challenge. This is a longer term issue, and it's really coming from the supply side. And so looking to AI, looking at retraining workforces, looking for, to use technology to raise productivity is what firms should be focused on in the long term for that. So a lot to digest, Joe, but there's a lot more in the report. So I know we've got a QR code here where folks can go and download that report. I don't know if we have time left for questions, but I'll stop there and hand it back to you, Joe.
Thanks, John. Yeah, we've run out of time for today. Apologize to any of you whose questions we were not able to get to, but thank you so much. And Daphne, I know you have a few words to close us out here.
Yes, thanks, Joe. John, thank you. Lots of great information as always. As you said, there's a ton more in the report. The state level data is in there. So please grab that off of our website or through this QR code. And I just want to thank all of you for joining us. I want to thank our donors who make not only the research, but these types of presentations possible. So thank you to this group for that. And we will be sending you an evaluation. Please send us your comments. They're very helpful. And until next time, I hope you stay well and have a great day.
Thanks all.